the remaining material in topic 3, paper 6, each section could be one question in the exam. So we're not going to get 5 or 6 questions from one or each of these sections. It would be one question per section if the questions pop up. And we start with section 6, Code on Open-Ended Fund Companies. And we've seen open-ended fund companies quite well examined recently. So as I've said in previous lectures, we really need to be on top of this. The open-end fund companies, starting at the top, allow investment funds in Hong Kong to be established as incorporated companies with limited liability and variable capital as an alternative to unit trust structure. So these are structures for funds that are administered in Hong Kong, not offshore structures in Hong Kong. The OFC code, which is issued by the SFC, applies to both public and private open-ended fund companies. Public company is authorized by the SFC. Private is not a public open-ended fund company. In other words, it's not authorized by the SFC. Okay, the code requirements applicable to all open-end fund companies cover general principles. You can read them as well as I, all the way through to termination, cancellation, and registration. We're told there are additional code requirements for private open-ended fund companies. This would be possibly private equity, covering, now this has been examined, investment scope. Private open-end fund companies are designed to operate as investment vehicles and so should not operate as corporate entities for general commercial business. So they're investment vehicles, so that they should not be used for anything else. And here's the point, at least 90% of an OFC's gross asset value must be invested in normal asset management classes of investment: listed equities, debt, foreign exchange, and cash. So I just said private equity companies. I was wrong. They would not be typical open-ended fund companies. It's where at least 90% are in listed equities, debt, foreign currency, classic asset management classes. Changes to the scheme. Any scheme any change to the scheme must have shareholder approval. Fund operations, instrument of incorporation clearly set out details of pricing, dealing, issue redemption shares, valuation, distribution policy, use of leverage, fees and charges. And finally, disclosure. Open-ended fund company must file its offering documents with the SFC as soon as practicable. Any changes to the offering document must be filed within 7 days of issuing revised document. So that is the code. We've looked at the rules with regard to open-ended fund companies. That's the legislation setting them up. This is a code. It's a code of conduct with regard to the operation of open-ended fund companies. Will it be examined? Nowadays, I would say yes. Good chance of a question coming from section 6. Section 7, quite a bit of material on real estate investment trusts, the authorization of them, the parties involved. They are trusts, they're not companies. So you're dealing with a trustee, not a custodian. The management company, again, we look at retirement of trustee, management company, and the other agents that are involved: listing agent, financial advisor, auditor, principal valuer. We have to be aware of investment considerations of real estate investment trusts. And other considerations, section 7.4, are listed there. I'm not going to go into the material in any great detail. It's reasonably straightforward to read through it. If there's going to be a question on REITs in paper 6, it will be one question. Now, another area that has been examined reasonably regularly, liquidity risk management circular. Now, this was effective 2017 onwards, and it applies to management companies of SFC authorized funds, and they are expected to follow a set of principles with regard to liquidity risk management. Now, the deal here is that if you are operating a collective investment scheme, you should do so in a way that investors can redeem their investments if they require. A problem arises when investors want to redeem and you've no cash, and your investments are illiquid. That is a problem. So that's why the circular lays out requirements for liquidity risk management. I want to draw your attention to 8.2, product design and disclosure. Management companies need to understand the profile of the fund's investors and their historical and expected redemption patterns. To understand that, you will then have some idea of what potential future redemptions will be and the timing. It then says management companies need to disclose in funds offering documents significance and potential impact of liquidity risks on funds and their investors. So the significance and impact of liquidity risks. You should also disclose summary of liquidity risk management process and liquidity risk management tools. That's getting quite specific. So if I'm reading an offering document, I should be gaining comfort that the management company has sufficient liquidity risk management in place. With regard to ongoing liquidity risk assessment, management companies should regularly assess liquidity profile of a fund's liabilities and assets, classify assets into different liquidity categories, setting internal targets, indicators, and how much should be invested in each category. I've seen points from 8.2 and 8.3 pop up in questions. Stress testing. Management companies should regularly stress test for different market conditions and adequacy of fund action plan and risk management tools. The stress test results should be reviewed by Liquidity Risk Management Committee senior management. But you do not have to disclose in the offering documents the results of the stress tests. Why do I say that? That was a distractor in a question that has been set. Liquidity risk management tools, finally, management companies should ensure that they have the necessary liquidity risk management tools in place. Okay, it's a one-off, be aware of it. I would say the open-ended fund companies, REITs, liquidity risk management, all of them worthy of a question each. Then we come to mutual recognition of funds under Section 9. Now, this is where Hong Kong recognize investment funds in other jurisdictions, and in turn, it's reciprocal that overseas jurisdiction recognizes Hong Kong funds. And it is a two-way recognition. So the first point at the top, collective investment schemes that have been authorized in a mutual recognition of funds jurisdiction can be authorized by the SFC under a streamlined process, allowing the scheme to be offered to the Hong Kong public. And when we have the mutual recognition, you have the home jurisdiction and the host jurisdiction. Now, the notes to date show 6 MRF schemes in place. The first one was the main one, China. But the SFC then followed up with Switzerland, France, UK, Luxembourg, and Netherlands. Okay, mainland China, Hong Kong MRF schemes, that's the ones we're looking at. We consider what eligible funds are. Now, only specified funds, this has been examined, only specified funds may apply under the MRF scheme. Currently they are general equity, bond, mixed funds, unlisted index, and physical index tracking ETFs. Moving to the next point, page 43, recognized mainland funds must be registered with China Securities Regulator for sale in mainland China, and must. So mainland funds that are going to be offered in Hong Kong must already be registered with the China regulator for sale in mainland China and must have been established for more than 1 year, have a minimum fund size of 200 million renminbi, not invest primarily in the Hong Kong market, otherwise there's little point in the reciprocal arrangement, and have no more than 50% of its total assets held by Hong Kong investors. Those 4 points have been examined. Please be aware of them. Ongoing requirements, recognized mainland fund authorized Hong Kong must observe following obligations. So mainland funds being offered in Hong Kong, in China must remain supervised, regulated by the regulator, remain compliant with its constitutive documents, which I would suggest is common sense. And then in Hong Kong, comply with regulations related to sale and distribution of the fund, comply with additional rules that are in Hong Kong, make constituent documents available for inspection. Here we go, have a bilingual offering document and a product key fact statement. If the original documents are in simplified Chinese, that's the characters coming out of mainland China, then traditional Chinese will be required in the Hong Kong documents, because the text, Chinese text in Hong Kong is traditional, not simplified. So just be aware, simplified in mainland China coming into Hong Kong has to be translated into traditional Chinese. If the fund ceases to meet host jurisdiction requirements, Hong Kong must notify the host regulator, SFC, cease marketing and stop accepting subscriptions. And then we have ongoing requirements in both jurisdictions that are listed there. As ever, I'm highlighting points that I have seen previously examined. Requirements on management firms and custodians are listed there with regard to mainland funds being offered in Hong Kong. And then we have points with regard to the application process, a mainland fund applying to be recognized in Hong Kong by the SFC for distribution. And please have a look through those yourselves. And finally, topic 3, mandatory provident fund products. Now, this is a section that could have a question or two, or could have no questions at all. So please read through this material in terms of pooled retirement funds. These are the old occupational retirement schemes. The MPF products under section 10.2. The SFC code and MPF products, so that's what the SFC is looking for when it is authorizing MPF products to come into the market. And then 10.2.2, registration approval by the MPFA under the MPFA's code and MPF investment funds. Pooled retirement funds under the Code of Pooled Retirement Funds, 10.3, moving on to investment of MPF products, the requirements under the SFC code and the MPFA code. And then lastly, the ongoing requirements of both the SFC code and the MPFA. Do I need to know all of that in detail? Well, remember, MPF products, it's probably going to be one question if it comes up, and there's a lot more material. So in terms of planning your time for study on topic 3, I would be certainly comfortable with open-ended fund companies, liquidity, risk management, REITs, and the mutual recognition of funds. The MPF products, I probably wouldn't do as much on. I would do the questions and hopefully I'll be there. Now, of all the SFC licensing exams, topic 3, paper 6 is probably one of the most detailed, and I'd say you're looking to answer between 18 and 20 questions on topic 3. So it is not something you can ignore. I would read through the material, but then I would do questions. You've just got to do questions, and that will focus your mind as to whether or not you know this material. And it's far easier to remember the material by getting it wrong, finding out why you got it wrong, and establishing the correct answer. And through that process, you will build up your short-term memory in terms of the detail of topic 3, paper 6. And as it says at the bottom of the page, I would strongly recommend that you go to Examinator.online, paper 6, and do the topic 3 practice questions, of which there are many, many questions. So good luck with topic 3.